Welcome to Sophie Dottie's channel. You know, for decades, investors were told a really simple story. The only thing that mattered was the market. But what if that was just the first chapter? Today, we're going to peel back the curtain on the hidden forces that really drive stock returns.
Right? We hear it every single day on the news. The market was up or the market was down. But this one question, it challenges that entire way of thinking. It suggests that just underneath the surface, there are these powerful currents at play, currents that can quietly make or break your portfolio.
In those currents, well, that's what we call factors. Now look, this isn't about picking individual stocks in the old school sense, not at all. Instead, it's about systematically targeting the underlying characteristics, the proven, persistent drivers of return that exist across the whole market.
To really get where we are now, we have to go back to the beginning. So our story starts way back in the 1960s with this, well, elegant and powerful idea, the Capital Asset Pricing Model, or CAPM. You can think of it as the first major attempt to create a scientific blueprint for how stock returns work.
The idea behind CAPM was beautiful in its simplicity. It basically said that a stock's expected return could be explained by just one thing. It's beta, which is just its sensitivity to the overall market. So if a stock was twice as volatile as the market, it should deliver twice the return. Simple. It was a really clean, logical theory, but it had a huge blind spot.
And here's that blind spot. When researchers actually tested CAPM against real-world data, they found it could only explain about 70% of a portfolio's returns. I mean, think about that. That left a massive 30% of performance just completely unaccounted for. It was this huge black box, and cracking it open was going to change finance forever.
So you can imagine, that 30% gap became a total obsession for a new generation of researchers. They started to suspect that what CAPM was just dismissing as random noise, well, maybe it wasn't random at all. They believed it was a signal, something systematic, something predictable.
Now, this leap forward happened in stages. It wasn't overnight. In 1976, Arbitrage Pricing Theory kind of opened the door, suggesting that, yeah, multiple sources of risk could drive returns. But it was just a theory. It didn't name them. The big breakthrough, the one that changed everything, came in 1992 when two researchers, Eugene Fama and Kenneth French, finally put names to those mysterious forces.
So what did they find? Well, Fama and French nailed down two powerful patterns that CAPM just completely missed. First, size. Smaller companies, for whatever reason, consistently delivered higher returns than you'd expect for their level of risk. And second, value. Stocks that were cheap compared to their book value, their on-paper accounting worth, tended to outperform expensive growth stocks over time. These weren't just flukes, they were persistent, systematic forces.
And here it is. This is the big aha moment. By adding just those two factors, size and value, to the original market factor, Fama and French could suddenly explain over 90% of a portfolio's returns. They didn't just tweak the model, they fundamentally changed our understanding of where returns actually come from. The black box was officially busted wide open.
Now, the Fama-French model was a huge breakthrough, but it was really just the beginning. Since then, researchers have identified other, really powerful factors that have become the core building blocks of modern investing strategies. So let's open up the Modern Investor's Toolkit and see what's inside.
First up is momentum. People often call this the premier financial anomaly. The idea is so simple. Winners tend to keep on winning, and losers tend to keep on losing. It's a really powerful factor, probably driven by human behavior, and it tends to do really well when the economy is humming along. And the way you measure it is by looking at a stock's performance over the past year. But, and this is interesting, you skip the most recent month to avoid any weird statistical noise.
Next up is quality, and this is exactly what it sounds like. Investing in strong, stable, profitable businesses. So you're thinking companies with low debt, high profitability, really steady earnings. Unlike the aggressive nature of momentum, quality is what we call a defensive factor. It's designed to hold up better when the market gets rocky.
And finally, we've got low volatility, and this one is a real puzzle. I mean, classic finance theory just screams that higher risk should equal higher returns, right? But the data actually shows the opposite. Less volatile stocks have delivered better risk-adjusted returns over the long run. It's another defensive factor, one that aims to smooth out the ride and protect your capital.
Okay, so we have this amazing, powerful toolkit of factors, but their very success created a brand new problem, an absolute explosion in the number of newly discovered factors. And honestly, it led to a kind of chaos.
University of Chicago professor John Cochran summed it up perfectly. He called it the factor zoo. And he was right. With researchers now claiming to have identified over 300 different factors, the real challenge becomes, how do you separate the lions, the truly powerful forces, from, well, the insects?
The biggest danger lurking in the zoo is something called data snooping. There's this famous saying in statistics: if you torture the data long enough, it'll confess to anything. And with thousands of stocks and decades of data, it's actually pretty easy to find patterns that look real but are just statistical ghosts, random correlations that have zero predictive power.
So, how do we tame this zoo? How can we possibly tell the difference between a real, robust factor and just a statistical fluke? Well, thankfully, researchers have developed a really rigorous checklist to do just that.
A real factor has to clear 5 pretty high hurdles. First, is there an economic rationale? Is there a good behavioral or risk-based reason it should even exist? Second, is it persistent? Has it worked consistently over really long periods of time? Third, is it pervasive? Does it show up in different countries and even in different asset classes? Fourth, is it robust? Does it still work if you define it a little bit differently? And finally, maybe most importantly, is it investable? Is the premium big enough to survive real-world trading costs? You'd be amazed how few so-called factors actually pass all 5 of these tests.
Okay, so maybe your curiosity's sparked, and you're thinking, this is cool, I want to play around with this data myself. Well, let's bridge that gap from theory to practice, because you absolutely can. Here's where you can actually get the data to explore these concepts for yourself.
What's really amazing today is how accessible all this is. The top 2 sources here, the data libraries from Kenneth French and AQR, are the academic gold standard. They offer decades of pre-computed factor data, all for free. But if you're the type who really wants to get your hands dirty, services like Alpha Vantage and Tingo provide the raw data, letting you build and test your own factors from the ground up.
So, let's bring it all together. What are the key things to remember? Number 1, the market isn't the whole story. Hidden factors like value, size, and momentum are persistent, real drivers of returns. Number 2, the shift from that old one-factor world to our modern multi-factor world was a genuine revolution in finance. And finally, number 3, always be a critical thinker. Beware the factor zoo, and demand real evidence before you accept any new claim.
And that leads us to the final and most crucial question. Because this isn't just an academic exercise. Every portfolio, whether you realize it or not, is already making bets on these factors. So the real question for you is, can you spot the hidden bets in your own portfolio? And more importantly, are they the bets you want to be making?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.